Well, it's finally here, folks. The big week is upon us. This week, we have one of the most important earnings weeks of the market because we have four huge companies, four of the most followed reporting earnings this week, including Tesla, Microsoft, Google, and Meta. These companies obviously are very important to the market. Investors follow them very closely, and we're going to be talking about them. But we also have a full slate of other companies we'll be looking over as well. This is one of the most jam-packed weeks of earnings we have this season. For example, if we go through the earnings week, on Monday, we don't have much. I was looking over Monday, and I don't personally see anything too interesting. I guess maybe Verizon that reported earnings. But when we move into the week further, we get into Tuesday. Tuesday, we have a lot of interesting companies. Before market open, we have PepsiCo. This is one that I followed for a long period of time. It's a dividend investor's favorite. PepsiCo is going to be one we're going to be covering. And we also have Spotify. This is one that a lot of people have very grandiose predictions of what's going to happen with Spotify, how it's like the Amazon of music. It's a company that continues to expand. I'll be talking a little bit more about Spotify and their upcoming earnings this Tuesday. And then on Tuesday, after market close, that's where things are going to get very, very interesting. Tesla is going to be reporting, and this is going to be, I believe, a crucial quarter for Tesla. And I don't say that frequently. I'm not someone to say every quarter is crucial for this company, but in this case for Tesla, I really think it is. So I'll be going over Tesla. I'll be giving you the context of what's going on with it and my perspective on the stock. And then of course we have Visa, which is not one that I personally own, but I have a large investment in MasterCard, which is a close companion with Visa. They have around 80% overlap in their business models. So I'll be looking at Visa as well. And then moving on to Wednesday, we have a number of interesting companies, but I believe the most important by far is, of course, Meta. The big social media company is reporting earnings. The stock has been doing excellent. Meta investors are sitting very happy, but there is very high expectations. So what's going to happen with Meta? We'll be discussing, we'll be looking at the context and valuation of the company. And then we have Chipotle. This is one that I have a personal investment in. I have around $30,000 of my own money in Chipotle. And this is one where the stock has raced up like crazy. It's at a very high valuation. And I'll be going over what my expectations are and what I believe the context is going into Chipotle's earnings. And then moving on to Thursday, we have another jam-packed day. We have two of the big cloud companies, Microsoft and Google, both reporting earnings after market close. And we also have Intel and Snapchat. Another two companies we're going to be looking at. So this week is going to be a busy, jam-packed week full of some of the biggest earnings in the market this season. But the goal of this is to give you context and perspective on these earnings reports, to give you an idea of what to expect going into them as a long-term investor. So we have a lot to get to. Let's go ahead and jump in. Now let's go ahead and start off the week. We're going to go through this left to right, Monday through Friday. We're skipping Monday because I don't have any companies I want to go over on Monday. So we'll jump into Tuesday before market open. We have PepsiCo here, a company that I've followed for a number of years. This is also a very popular one amongst dividend investors. I'm going to have some criticisms for PepsiCo, and I hope you're okay with that. This comes from a good place. I'm not trying to beat down any investors that are in Pepsi. But when I look at PepsiCo and I do more and more analysis on this stock, I become increasingly convinced that this is a stock that's good at a lot of things, but great at nothing. It's a stock that really doesn't check the boxes to be a great investment in any specific category. For example, a lot of the reason that investors buy PepsiCo is to have a stable dividend-paying company. Specifically, they call it a dividend growth company. So if you're a dividend growth investor, PepsiCo is one of the first companies you look for. Let's go ahead and take a look at PepsiCo with its current dividend growth. We look at a company that has a 3% dividend yield. So if we look at it right now, it's actually around 2.9%. That's okay, but it's still below 3%. If you're looking for just payout, you can invest in something that has a much higher yield. So it's not the highest yield starting, but then we also look at the dividend growth. The dividend growth over the past 5 years has been 6.4%. So we look at this in the past 10 years, and the dividend has been decelerating in its growth, growing a little bit slower. I guess last year it was 10%, but they're having a tough time keeping it above 5 to 10% growth. We compare that to other companies, other dividend growth companies. We can look at Texas Roadhouse here. Texas Roadhouse has a starting yield that's a little bit below Pepsi. So you have a lower starting yield, but the dividend growth is over twice as much. It's growing 15% per year, 11% per year. Over the past 5 years, it's grown 15%. So this is much more rapid growth. Your dividend's going to double in 5 years, and then you'll be ahead of PepsiCo. So if you're investing for over 5 years, this company's going to have a higher yield on what you're paying than PepsiCo. So even with the dividend growth thesis, I don't view PepsiCo as the best dividend growth company. Now, there's other investors that are respectable that invest in Pepsi, like Terry Smith. He has always had this company in his portfolio. And I believe it's like a pretty large position. It's right here, 4.71%. So this is one of his top holdings. It's holding like number 7 or 8. This is a large position for him. And I believe the reason that he likes this is because they have pricing power and because they're defensive. But PepsiCo, I believe, has also flexed its pricing power to an extreme degree. We can look at a lot of consumer behavior, and they're pushing back on products like this. When you go into the grocery store and you look at the bags of Doritos or Frito-Lay chips, and it's like $7 or $8 for a single bag, that's expensive. That's expensive even if you're making a lot of money. That stuff is expensive. And a lot of people, I believe, are going to turn to cheaper brands. You know, the kind of white label name brands that the stores sell, the Kroger's, the Kirkland Signatures, the Great Value. A lot of people are turning away from the name brands because they're flexing their pricing power too much. We have an article here. This is just from February of this year. People are turning away from Pepsi's brands because they're too expensive. Very simply put, and this article, this is not clickbait. This is through the numbers. So Pepsi is also a company that it does have pricing power, but that pricing power has limits. It has limits because it has a lot of competition. We also look at the company as being defensive. Let's say you want to find a very defensive company that has a great balance sheet. Well, we can look at PepsiCo's balance sheet. Right now, if we bring up the balance sheet, we have a company that just has way more debt than it has cash. Look at the amount of cash it has, $10 billion in cash. That's a lot of cash, but it has $37 billion in debt. So it has 3.7 times as much debt that it has cash. And overall, that's around $27 billion in excess debt. That's a lot of excess debt. When you look at that, $27 billion, they can't afford that, so they're not in trouble. They can pay that off in a year or two. But again, I can compare this to other companies. Other companies that I think are equally as defensive as PepsiCo. A company that I would argue has a larger moat and is more defensive than PepsiCo is Costco. Costco is, I believe, a very defensive company. They sell PepsiCo products. They sell, Procter & Gamble products, and they sell toilet paper and grocery. They're a very defensive company, but you look at their cash balance, and they have more cash than debt. We can also look at other companies, again, that are very defensive. MasterCard and Visa, two companies we're going to be going over a little bit here. And MasterCard has, a far better balance sheet, $9 billion to 13. They have barely any more debt than cash. And PepsiCo has 2.5 times more. So there's other companies that I think are growing their dividend faster. They have a better balance sheet and they're equally as defensive. So overall, when I look at PepsiCo, you can try to argue this company from a dividend growth perspective, but I think there's better dividend growth companies. You can try to argue this company from a defensive perspective, but I think there's better defensive companies. You can try to argue it from a growth perspective, but PepsiCo isn't growing that fast either. When we look at the fundamentals here, it's growing its top line revenue at an accelerated pace over the past couple of years, which is very good to see. But again, a lot of this is the result of pricing power since 2020. They started to rapidly increase prices, and I believe that's getting stretched. Last year, they grew revenue by 5.86%. So that is a good increase. That's faster than usual, but I don't know how long they're going to keep this up. Now, when I look at their free cash flow growth, this is the economics of the company. We can zoom in over the past 10 years, and the free cash flow growth is basically flat. In fact, it's almost entirely flat over the past 5 years. We can look at this on a per share basis. Maybe they've been doing a lot of buybacks. They have not, because they've been paying a dividend. So the free cash flow per share is completely flat. It's gone up a couple percentage points over the past decade. There's almost no core intrinsic value growth here over the past couple of years. And I believe that's why this stock has underperformed over the past 3 years. They're not growing their economics fast enough. So for me with PepsiCo, I don't know. I don't believe it's the most attractive investment in a lot of different terms. I can find companies growing their dividend faster. I can find companies with a better balance sheet. I can find companies with much faster free cash flow growth. And I can find companies that I think are even more defensive. So there's just other companies in almost every category that I believe are a little bit better. Overall, it's a solid company. I don't think it's a terrible one. That's not the picture I'm trying to paint, but I just think there's better companies for any specific thing you're looking for. PepsiCo's just okay at all of them. Going into this earnings, I don't know if they'll beat or miss. It's hard to say, but I think it will be very close because we just had Procter & Gamble report earnings and they had disappointing earnings. Disappointing because consumers are trading down. And we heard the same thing from Andy Jassy. Consumers are wanting to save money and they're looking for the best value they can find. So premium brands like Frito-Lay and Pepsi that have done a lot of price hikes, I think are going to have a little bit of a difficult time with this earnings season. Now, next up, still reporting earnings before market open Tuesday is Spotify. And this is a company that's had a remarkable recovery. It's going back up, I believe, very close to all-time highs. We can look at the stock chart here. Spotify is at a price right now, let's take a look at $270. We look at it right here over the past 5 years. It's not at all-time highs, but it's getting close. All-time highs are right up here. It's right there. We're within like $50 from all-time highs. So the company has largely recovered from the huge dip. And that's because they've been putting up some great numbers and they've continued to grow and continued to execute. And Daniel Ek has done an excellent job of growing the actual amount of real economic free cash flow this company has generated. Now, it's still a small amount, but they've proved to investors that they can produce real profits, not just stock-based comp, diluted profits, but actual real profits. Another thing that Spotify has done that I think it gives investors a lot of confidence here is this number right here, 602. That is how many million subscribers, or rather million users that Spotify has. 602 million. So many. You have over 500 million users using your platform. Now, there's a lot of downsides to Spotify, and I think the biggest problem with the company is even when you get a lot of listens, even when a lot of people use it, most of the economics goes to the music labels. So you have news like this. The Tortured Poets department breaks record for Spotify's most streamed album in a single day. These new albums from Taylor Swift, the Taylor Swift Effect, which I'm not a Taylor Swift hater, but me personally, I listen to some of the songs and they all kind of sound the same to me. Maybe I'm just getting old or something, but a lot of her music, I just feels like it feels the same. It feels like the songs are the same. I really don't mean to be a hater, but that's how it comes across to me. Regardless, Spotify, it just doesn't matter if stuff like this happens. Her album breaks records and streaming on Spotify. Well, that's good for Spotify, but most of the people that made money in this relationship is Taylor Swift and the music labels. Spotify didn't make a lot of money from this type of news. So it's a difficult economic situation, but they're doing everything they can to diversify, and they're doing that somewhat successfully. They've already become the leader in podcasts. So Spotify has diversified away from music that direction, but they've also are moving into audiobooks. This is more into Amazon's territory with Audible. Spotify is now offering a lot of free audiobooks to their subscribers. So they're just diversifying across audio and they want to become the all-in-one audio platform. So I don't own it, but overall, I'm still bullish going into this quarter with Spotify. The stakes are higher because the valuation's a little bit higher now, but they still have a lot of fundamental momentum. A lot of people are moving to Spotify. They still have a very sticky platform. And as long as they continue to gain users and show momentum, I think the stock will continue to do well. Now we're still on Tuesday, but next up we have after market close, Tesla reporting earnings. Oh boy, here we go. There's a lot of opinions on Tesla. And rather than just throwing in some vague opinions of whether or not Tesla's good or bad or whether Elon Musk is good or bad, let me go ahead and just give you some facts. Let's focus on the facts first. The first fact is that over the past year, Tesla has routinely cut prices of their vehicles. The most recent cut was just a couple days ago. They cut the price of the Model Y, X, and S by $2,000. Prices going down for anything, almost always means that there's a lack of demand. There's not enough people willing or capable of paying that amount, so they have to lower prices to meet that new demand. So one of the big thesis of Tesla investors just a couple of years ago was unlimited demand, that they're selling every vehicle that they produce. That's true that they're doing that, but they're doing it by lowering prices on their vehicles. Fact number 2, Tesla lowered prices on their full self-driving subscription by 50%, from $200 per month to $100 per month. Now, again, there's all sorts of opinions on the reason they did this, whether or not it was to get a land grab of subscribers so they can raise prices later. That's a good idea, but all we know right now, what we know as a fact, is that they cut prices in half for their full self-driving. A week later, they lowered the price of buying the full self-driving outright from $12,000 to $8,000. So we have another significant cut on either buying it to own it for the duration of the vehicle or buying it under a subscription. Fact 4 is Tesla missed their quarterly delivery number big time. Their quarterly deliveries declined for the first time in nearly 4 years. Another indication that the company's struggling to sell its vehicles. So this year so far has been a rough one for Tesla investors. The stock is on a steady downtrend as there's more and more news signaling that the company's struggling with demand. When we look at this year, the stock is down 43% year to date, making it one of, if not the worst performing stock in the market this year. Then we look at the past 5 years, and we can give this some context. You could have made a lot of money if you invested in Tesla back in 2019, but the price it traded at in 2019 was like $12 to $15. So if you're buying Tesla for $12 to $15, those are great purchases. The company's worth more money than that. So the stock has gone up a lot since then. But as soon as you get into 2020, if you bought the stock any time period after 2020, you're almost certainly in the red unless you perfectly time the dips at the lows. So there's a lot of investors that bought into this company over the past 3 years that are sitting in the red wondering what to do. One of the things that keeps me out of it is the cyclicality nature of a company that sells a product that you need financing for. Cars are very expensive, solar panels are very expensive, so the businesses that Tesla is in are very, very expensive, and they're products that typically need financing. When interest rates go higher, it's much more difficult to finance these products. So we look at the operating margins of Tesla, and right now they're around 8%. Tesla's hoping to get these up to 9%. They're hoping to grow their operating margins over the next quarter. It's going to be difficult to do that with lowering prices. We look at the highest point this has ever gotten, around 19% one quarter, around 17%. This is the highest operating margins that Tesla has ever had. A combination of stimulus checks, low interest rates, and tax credits has led to them getting very high operating margins for a car business these couple of quarters. But then we look at that compared to other more mature companies. If we look at that compared to Apple, for example, the highest operating margins that Tesla has ever had during the optimal time period was around 19%. The normal operating margins for Apple is around 34%. So Tesla would have to triple their current operating margins to get to where Apple is. And I think it's very difficult to do that. The only way Tesla's going to achieve that is if they have a breakthrough with their full self-driving, if they do have the robo-taxi thesis play out. And now that's what Tesla's counting on. Tesla investors are getting hit left and right. They're taking a lot of arrows right now, and they're trying to put up their defenses, and they're trying to say, look, even though the company looks like it's in a tough spot, even though there's difficult financing vehicles right now, and they're not selling as many vehicles, and they're lowering prices left and right, we still have this pot of gold at the end of the rainbow, and that is full self-driving. Tesla's going all in on full self-driving and specifically the robo-taxi, which is connected with that. Because if Tesla can get to full self-driving, not just level 2, but level 5, then they can have a massive robo-taxi advantage. There's already so many Teslas on the road that if they achieve this, they'll have the biggest robo-taxi network by default. So everything is counting on this thesis playing out. If that happens, that's a great thing for Tesla investors. If they have this massive robo-taxi network and they're the leader in that category, Tesla's valuation is arguably justified today. But that's a lot of risk. It's a lot of risk counting on something happening in the future that isn't proven so far. So Tesla is higher risk than other companies. Simply put, it's a company that's reliant on a major step change in technology in the future to justify its current valuation. Investors today in Tesla are relying on this robo-taxi pot of gold in the future. And the future, in many cases, unfolds in ways that we don't expect. So I believe investors in Tesla are investing in a company that's just higher risk than other companies. I personally avoid investing in companies that I consider to be high risk. I invest in companies that I consider to be very low risk. We can compare Tesla to Amazon, for example. Amazon's another company that seems similar on the surface. It's both in artificial intelligence and robotics, and it's planning on having big explosive free cash flows this year. But Amazon is much more incremental, iterative than Tesla. Amazon has already been producing profits in ads for years. I can map out the profit growth in ads quarter over quarter. Amazon is already making a lot of money in AWS. I can map that out quarter over quarter. Amazon is already making a lot of money in their seller services. I can map that out quarter over quarter. The businesses that Amazon are in are predictable and iterative, and they grow every single quarter. With Tesla, that is not the case. The prediction of a large robo-taxi business in the future is a large step change from the current situation Tesla's in. It's not an incremental improvement in business lines they currently have. So that is much more risky, I believe, than investing in Amazon. Now, when we look at Tesla now, it is true the price has come down a lot. It's down 43%, but I still believe that Tesla has a lot of risk baked into the stock. I still believe so. Looking at Tesla's current valuation, to me, it still looks expensive, whether or not you value it on earnings or free cash flow. If you value it on earnings, it's at a 57.8 forward PE ratio. That's obviously very high expectations on earnings. If you value it on cash flows, it's still below a 1% free cash flow yield. And we can look at the free cash flow over time. Tesla did $4.36 billion in free cash flow in 2023. If we zoom into 2024, the expectations right now are around $4.5 billion, 4.4. If they accomplish their expected free cash flow in 2024, it still trades at a very expensive 1% free cash flow yield. For a company that's having fundamental issues right now with lowering prices and trying to sell more vehicles. So no matter how I look at Tesla, I personally view it as still with a decent amount of risk. I still think a lot of investors are taking on a lot of risk in this stock. Tesla could fall a lot further than its price today. I am concerned with Tesla this quarter. This year has been tough for the company. The amount of price decreases has also caused concern. So I do not feel confident with Tesla this quarter, and I think that management is likely to try to focus the conversation more on the robotaxi and the future of the company than the current fundamentals of the company. But maybe they can surprise. Elon Musk has done it in the past, so we'll see if he can pull a rabbit out of a hat. Next up, we jump into Visa, reporting at the same time as Tesla. I don't think Visa is going to get a lot of attention. Tesla will overshadow Visa's report, but Visa is a very, very important company. And in my opinion, I think Visa is one of these companies, along with MasterCard, that you can almost look at any time period ever, and investors that have invested in this company are just happy. They're happy investors. They're having a good time all the time. Doesn't matter whether they invested a year ago, 5 years ago, 10 years ago. You're not going to find Visa shareholders that really regret investing in this company. It's been such a reliable compounder of capital for such a long period of time that investors in it are either just rich or they're just hanging on to it and becoming rich over time. And that's because of how good of a company this is. Visa is a duopoly with MasterCard. Both of them are digital companies. They are software network protocol companies. They're not banks. They're not really even financial companies. They don't lend money. They just connect different parties together in a massive network. And they scrape off a tiny fraction of a charge in the process. The majority of the transaction charge when you swipe a card goes to the bank because a bank is taking on most of the risk. But Visa makes a tiny bit of money in the process. And because there's millions and billions of transactions, they end up making a lot of money overall. They have an incredible balance sheet. They have, I think, a great valuation right now. I'd be fine buying Visa right now. They have consistent growing free cash flow, unlike most companies in the market. We look at the free cash flow per share, and it's just incredible. If we zoom out over all time, this is what it looks like. Consistent growing free cash flow per share. And that is what I expect overall, year over year, quarter over quarter with Visa. I expect very few years where it goes down. It went down in 2020 for obvious reasons, There's some years where there can be a slowing in the economy, it can go down. But with the amount of free cash flow they generate, with their buyback efficiency, I believe they're going to grow free cash flow per share continually. Overall, I expect this company to compound around 14 to 15% per year, so well above the market. And it does that while taking on, I believe, very little risk, because the company has as much cash as debt. Now, I don't own Visa. I own MasterCard because I believe it has a few little advantages. MasterCard has a bit more international exposure and international growth. MasterCard has a bit more fintech exposure, and MasterCard has a bit more value add services. So I like MasterCard slightly more than Visa, but I like both of them a lot. I think both of them are great companies. I'd be fine having Visa in my portfolio. The nice thing about being a Visa or MasterCard shareholder is you go into earnings season without really any anxiety. There's no concerns going into earnings season. You know it's typically going to be business as usual. These companies almost always hit their earnings metrics. They do so well with earnings. There's a chance they can come in slightly below, but it's usually a slight miss. So Visa is not one that I'm concerned about at all. I think if you're a shareholder going into Tuesday, I just don't think you're concerned about this at all. Now, moving on, we move into Wednesday and we have two companies after market close. The first one is the first big tech company, which is Meta. Meta is a company that I've always underestimated a little. The fact that they're continuing to grow at their current scale and size is incredible. I always think Meta is such a large company. Facebook is already so huge, but then somehow they continue to grow in the amount of users. It's actually startling to me. When I look at Meta's most recent report, Q4 of last year, their family daily active people, so the amount of people using the app, was up 8% year over year. The monthly active users was up 6% year over year. Facebook, which has been around for over a decade now, was up 6% year over year in the amount of usage. 2.11 billion people. Where are they finding more people to use this app? It's just incredible. It continues to grow. So when I look at Meta, it's a company that I look at and I think growth has to slow down. They're not going to find any more people to use the app. Everybody on planet Earth is using it. And then they grow by like 8 to 10%. That to me is incredible. So credit where credit is due. Meta continues to grow, and I don't know how they're able to do it. Now, the PE ratio of this company is a 25 forward PE. So investors are pricing this now up there with the big boys, with Google, with Apple, with Microsoft. They're giving the company a lot of respect. So they have high expectations for Meta. It's also being priced right now with a free cash flow yield of 3.55%. Now, that's higher than most companies, but that's because Meta does have a lot of things that help out with their free cash flow. For example, when we look at this on an annual basis, they do have a lot of stock-based comp, which helps out with the free cash flow number. So if you look at the free cash flow and stock-based comp, it's a decent chunk of it, around 30%. But even when we factor that in and we look at the free cash flow per share growth, it's super impressive. It really is. What Mark Zuckerberg has done with this company is very impressive. And it shows that Mark Zuckerberg is extremely competitive. He seems determined to create the new computing platforms, to compete with Apple, to be in artificial intelligence. He is doing huge investments with Meta. He's not just sitting there and sitting on what they currently have. He's creating new growth paths in the future. So I really like what I see fundamentally with the company. It's super impressive. I think Meta going into this earnings report is going to be decent. I think people are addicted to social media. They're not going to give it up. I think the advertising market has been really good over the past year. And so I see more usage for Meta, more advertising growth, and better optimization of the ads. They've done a lot of work in making the ads highly optimized, making so that they make a fortune from these ads. So going into this quarter, I think that Meta is going to have a very positive quarter. I also think they're going to emphasize all the investments they're doing into AI. Meta is one of the biggest buyers of AI chips from NVIDIA. It's a company that has many growth paths in the future. So this has been, to me, one of the most underestimated stocks, and they continue to blow away my expectations. Now, at the same time, Wednesday after market close, we have Chipotle reporting their earnings as well. Chipotle is one of the highest valuation stocks in the market. If we look at it right now, this is what it looks like. It's a food joint that sells burritos. So this is the burrito company trading at a 55 forward PE ratio. It's trading at the same PE as Tesla. And again, they sell burritos. A lot of people like to mention that it's such a simple company selling a simple food, trading at a high valuation. The free cash flow yield, although, looks a little bit better. It's trading at a 1.5%, 1.4% with stock-based comp. Now, looking at Chipotle, this is a company that I own. a decent amount of. So I have Chipotle here in the passive income portfolio, along with Texas Roadhouse. These are my two food companies that I invest in. Everyone has to eat, and both of these companies provide food with great economics. Chipotle is a company that I was buying at $1,900 per share. That's when I bought into the company. It quickly raced up to almost $3,000 per share. Right now it's trading at $2,871. Now, that is a huge increase in price. So in less than a year, I made $11,000 so far with the company just because it raced up in stock price. That was because Chipotle beat expectations a lot, and they raised their same-store sales guidance. So Wall Street thought it was going to go down. It actually went up, and therefore the stock had a huge adjustment upwards. Now, looking at this company overall right now with the expectations, Chipotle is being priced as a prized asset in the global economy, in the world. It's one of the best food chains that has scaled to the size it has, with over 3,000 restaurants, doing $3 million per restaurant, having great unit economics. There's not many companies like that in the world. There's only a handful of them, McDonald's and Starbucks. Then you have a company like Chipotle. But Chipotle is also unique and different than the rest of them because they don't sell burgers and fries like a lot of other companies. So this is a highly scaled, fresh food type of restaurant. And that, I believe, is a prized asset. So I look at Chipotle over the long term, and I realize that this upcoming earnings could be bad. It's priced really high. If they miss or if they disappoint in guidance even a little bit, the stock could drop like 10%. That could be a reality, but that would not concern me with my overall investing thesis on this company. This company has incredibly good unit economics. It has an incredibly good CEO. It has a very good team. It has wholly owned restaurants. And the free cash flow growth is explosive for this company. Look at the free cash flow growth over the past 5 years. The stock has followed the cash flows of the company. When we look at this on a per share basis, it's growing even faster because they do share buybacks routinely. So this has all the fundamentals that I like to see in a company. Global scale, sells a product everyone likes, has great unit economics. I believe that it has a brand and a moat that's very difficult to compete with. And so I like the direction it's going overall. Going into this quarter, I think Chipotle's earnings are going to be good. That's my opinion. Now, there's no guarantee. Maybe they'll disappoint, but I think they're going to be good because Chipotle's food that people like. It's food that's really good on the go. It's healthier than most options, and most of their customers are in an income bracket that makes $70,000 a year or more, so they can afford a $10 burrito. And the burrito bowls are typically a better value than a lot of other food companies, than what you're getting at McDonald's or what you're getting at Burger King. They also brought back the chicken al pastor, which is a very good performing item. Around 20% of the sales at Chipotle buy this chicken, which is $1 more. So that will certainly affect their margins as well. So overall, I realize the valuation is very high for Chipotle. It does not leave room for error. If they have a big disappointing quarter, the stock is going to go down quite a bit. But as far as I can see right now with every indicator, I think they're going to have decent earnings. Now, moving on throughout the week, we get into Thursday after market close, and this is where we have a very full slate of companies. First of all, we have Microsoft, which is one of my large investments. I've held Microsoft for years. Microsoft, I think, is one of the best examples of having nearly perfect fundamentals in a company. By the fundamentals, I think a complete overview of all the financial statements of a company. You have a company that grows its revenue continually, grows its economic value continually, the free cash flow and the free cash flow per share. The company does buybacks, it does dividends, it does it all. Microsoft is a well-rounded company, and almost all of its revenue is subscription-based as well. It continually has 70% gross margins, high operating and profit margins as well. So the company overall has been incredibly well ran by Satya Nadella. And going into this earnings, the quick summary here is, I think it's going to be good. I think Microsoft will beat on both their top and bottom line, and I think they're going to flex their muscles with their cloud computing once again. The company is the second place in cloud computing, which is a very enviable position to be in. The market for cloud computing, I believe, is already largely established. So most S&P 500 companies, most of the top 1,000 companies in the US, they've already picked a cloud provider. They've already picked either Amazon, Microsoft, or Google. One of those companies is providing cloud services to them, and they might have some services on one and some on the other, but overall, they are growing into these businesses. The market is already captured by these companies. Microsoft, Google, and Amazon. Microsoft being in second place in cloud is a great position to be in. So you have a cloud juggernaut here, a subscription juggernaut that has immense pricing power that's deeply ingrained in the US's economy. And I think that they're just in such a good situation. The valuation, in my opinion, is also not extreme. It's not the best it's ever been. Being nearly $400 per share, I would not say it's cheap right now. And I have said this company was cheap in the past. I have a video going back a little over a year ago, and I said big tech is cheap. And Microsoft was trading at $220. So $220 there. I thought it was really cheap back then. That was kind of a pound the table moment. Buy Microsoft. It's a very cheap company. It's not that way anymore. At $400 per share, I think it's close to fair valued. I think it's bouncing around that territory. So this is not a pound the table, buy the stock, it's super undervalued type of situation, but I still think it's at a decent valuation. And the reason why is because of the quality of this company. Most companies that trade at a 30 PE ratio and a 2.2% free cash flow yield, they better have incredible qualities to justify that valuation. And Microsoft has incredible qualities. Second place cloud leader, big leader in AI. The company has almost all subscription revenue, on and on and on. It's just one of the best fundamentally, and nothing has changed in my thesis. The company is probably getting stronger, not weaker. The company is growing in its moat, it's not shrinking its moat. One of the craziest things about Microsoft is how fast it's growing at its current market cap size. You don't see companies that are growing this fast at this size. For example, right now, the company's a $3 trillion company. $3 trillion, and they do $211 billion in revenue. So this is one of the ones that you think it's so big, right? The growth is over. It's in the mature phase. It has to be growing in like single digits along with GDP. No. Microsoft is a company that if we look at the revenue expectations, the average analyst revenue expectation for this year is $244 billion, going from 211, around 212 to 244, which is around 15 to 16% revenue growth. You have a company that is massive, that is still growing faster than many startups. That's what they've been able to accomplish. So you may be under the impression that Microsoft is simply too big to continue growing. That's not the case. As far as I can tell, as far as the fundamentals look right now, this company is in position to continue growing quickly. So I don't believe that Microsoft is so cheap, it's a pound the table, buy it now moment, but I still believe over the long term, it's a better bet than most companies in the market. And I do believe it will still be a market-beating company. Next up, we have Google. I own Google shares as well, and I'm not concerned going into this earnings. I feel comfortable going into this week owning Google because the valuation is not extreme. Right now, currently, Google trades at a lower valuation than Meta. That's a change. Google's a cloud computing king. It's a company that's third place. But you have the company trading at a 23 forward PE ratio, a 3.5% free cash flow yield. When you adjust out stock-based comp, that's 2.4. Either way, the company is not terribly expensive right now, as far as I'm concerned. Now, the stock has been doing well over the past year, up 47%, but it still hasn't been performing as good as many other technology companies. We look at Google's free cash flow. This also looks very encouraging. They hit an all-time record high in free cash flow last year, around $70 billion. We look at the free cash flow per share. They're doing buybacks. So that is growing at a rate around 27% over the past 5 years. Very fast free cash flow per share growth from Google. Very, very fast. Now, if we look at the balance sheet, Google's a company that has a ton of cash on hand, $110 billion. And they're trying to use this cash balance. They're trying to find ways to spend that money. One of the rumored ways is that Google is in discussions to buy a company called HubSpot, which is a competitor to Salesforce. It's like a smaller version of Salesforce that's easier to use, but doesn't have the same functionality as Salesforce. Now, why would Google want to buy a Salesforce-like company? Because then they'd control the entire funnel vertically. They'd have the ads integrated into the customer, and that would give them more data and insights. So there is some level of integration they could do here, but this company is a now $32 billion market cap company. In my opinion, I believe Google would be better off. This money would be better spent buying back their own stock. just using $30 billion and continually doing buybacks throughout the year to lower their cash balance. Because right now the stock is not overly expensive, and buying more of it means that you have a greater ownership in this company. So I'd rather have Google spend the money to buy back their own shares than buying HubSpot, which I think is a little bit value accretive, but I don't think it's as good of an option. But overall, when I look at Google, I see nothing wrong with this company. Third place in cloud hosting, which is a good position to be. The cloud is now profitable for Google. The company still retains its dominant lead in search. I don't believe that LLMs are going to disrupt that. When I give an honest review of Gemini against ChatGPT, I haven't reviewed every single latest feature between the two of them, but Gemini is getting pretty good. I've been using it and it's pretty impressive, some of the things it can do. So I think that Google's still doing a great job with their artificial intelligence, with their LLMs, with Gemini. Right now, I'm bullish on Google. I think the company's in great shape. I'm not concerned going into this earnings. I think they'll beat on their earnings per share and revenue. I think they're going to show off how many YouTube subscribers they have. I think that they're going to continue to grow. So I'm still bullish going into this company. Right now, I have no big concerns. Now, at the same time, we have Intel reporting earnings after market close on Thursday. This is a stock that I've never been bullish on. It's one that I think is in a very difficult industry with very big competitors. And I've also seen what big tech can do to Intel. One of the things that concerned me the most about this company years back was how rapidly Apple was able to move away from Intel. Remember when Apple came out with their own silicon and then they no longer had the Intel inside? Apple stole a lot of the key players from Intel, a lot of their talent, and then they developed their own internal silicon so that they could build their own materials without licensing it for $100 a chip from Intel. And that boosted Apple's profits. They had huge incentive to do that. And at the same time, it really hurt Intel because that's one of their bigger customers gone. So ever since then, I've become more skeptical of Intel's moat, believing this company is one that is subject to having rapid changes in the market. And it's also a company that historically is a little bit more cyclical than I'd like. I don't invest in chip makers to begin with. When I look at the company, it's trading all over the place. On a PE ratio, it's at a 26. The free cash flow is minus 10% yield right now. And that's because, well, the free cash flow is negative. So you have negative free cash flow over the past 2 years. They're doing a lot of investments. They're trying to do big investments for the future that will hopefully pay off with a high return on capital. The only positive thing I really like about Intel is not something so much with their fundamentals, but with their leadership. Right now, the CEO of the company is continually purchasing more shares of the company. If we look at the insider trades here, we can see him purchasing more of the stock February 1st, 2024. This isn't him being granted it as part of his compensation. No, he's actually buying shares. Just like an investor, he's going in and buying shares. So I see him buying more and more shares. Now, he has some that's part of his compensation, but he has other times where he's just buying more with real amounts of money. So a lot of this is real market value that he's buying, meaning that the CEO, the lead executive of the company, believes the stock is going up. And I do like seeing that. But even with that, it's just not enough to get me in this stock. It's not enticing enough. Intel lacks the qualities that I like to see in a stock, which is a deep moat, a company that has capital efficiency and very consistent cash flow. So far, this company has inconsistent cash flow. It has a moat that I think is less deep than investors believe. And despite the CEO being very bullish, I still think it's a very risky endeavor. I can't say whether or not they'll beat earnings. I think it's a coin flip. So this is one that's very difficult going into this earnings season. I have very little confidence in Intel. Now, finally, at the same time, reporting earnings Thursday after market close, we have Snapchat, a company becoming known for dropping 15% to 25% after earnings. It's done this so routinely that I actually tweeted last time. I put out a tweet, when a stock falls 15% after earnings, do we call that pulling a snap? It seems like they're working hard to have that named after them. And I joked about this because Snapchat dropped another 15% after earnings in this earnings report back in July of 2023. In the very next earnings season, the very next one after this, Snapchat plunged 25%. So again, this isn't an unusual thing. Snapchat's a company that when you look at it, it just drops 15, 25, 30% after earnings routinely. And investors still jump into this stock based on this story. I haven't looked at this company that much. Frankly, Snapchat is not one that I'm going to spend a lot of time doing fundamental analysis on because I have no interest investing in this company. But if I'm going to gamble here, and I was going to predict which direction Snapchat is going to go, I'm just going to go with the odds. For the last 2 quarters, it's dropped 15 to 25%. I'm going to say, just because of random chance, that Snapchat's going to be up over 10% after earnings this quarter. Don't bet on that because this is completely random, but that's my guess, over 15%. And that's going to conclude this week. If you want follow-up on all of these earnings reports, if you want to see my post-analysis where I go into the stocks, I look at the earnings report, we look at the fundamentals, and we give commentary on what's happened, make sure you subscribe to the channel, and make sure to hit the little bell notification so you get actual notifications. Other than that, I'll see you in the next one.